situation where we lose control or we lose significant influence. So if we lose control, we need to de-recognize our assets, and it will be all our assets and our liabilities, including any goodwill. So don't forget about goodwill. The NCI will also need to be de-recognized, and we'll then recognize the fair value of the consideration received. And we will also recognize the investment that has been retained. We will recognize that investment at its fair value. So this B1, second bullet point, I don't think you need to be worried about, but just to give you a sense, this is when we lose control after we have declared a dividend in specie. So I've got shares in a company, and I then said, oh, all right, let me declare these shares to what? To my shareholders. That is what is dealt with in this number B. But as I'm saying, unbundling is not something that is core. Then they say we need to reclassify to profit or loss or transfer directly to retained income any amounts recognized in what? In other comprehensive income. And we need to recognize any resulting difference as a gain or loss attributable to the parent. So in simple words, I'm sure B98 is one of those nice things that you probably enjoy. So we've got what? We've got de-recognizing the net asset value. So that is what B98 tells us. It also tells us to de-recognize goodwill. And by doing that, we'll de-recognize all the assets. Then we need to remember to de-recognize the what? The NCI. And recognize the fair value of the investment retained and the consideration received. And essentially, what you need to pick up here is that these amounts can be done very easily or determined quite easily using the analysis of equity. So my recommendation here is for you to consider the use of the analysis of equity in responding to this. It is to do what? Use the analysis of equity to your favor. Then what you then find out is that your tutorial letters give you guidance in terms of what? In terms of what they prefer. Sometimes they prefer, so they've clarified that they prefer a situation where you don't consolidate and you just simply bring in your share of what? Of the profits in here. So what do you then need to do? You then need to say at acquisition, so this is the approach number one, is to consolidate and deconsolidate. So let's just talk about what you do at different stages. So at acquisition, you eliminate the what? You eliminate the equity of the sub, the investment, and recognize what? And recognize NCI. Then at since acquisition, what do? You then attribute post-acquisition reserves to what? Post-acquisition reserves to NCI. Then current share, you attribute P&L to NCI, OCI to NCI, and you eliminate the dividends. So as a basics, eliminate the dividends. So this is what we expect to see in each and every step. So that is when you consolidate first, and you then need to what? To deconsolidate. Then when you lose control, what do? You then credit, you then debit all your liabilities, credit all your assets. and then debit your NCI. And you recognize what? Your gain at group level. And you remove the gain in separate financials. And what? And you have the investment. So that is what you do in terms of what? In terms of approach number one. Then approach number two says that do not consolidate. So what it means that at acquisition, you do nothing. At acquisition, you do nothing. Since, notice the difference, you bring your own share. You bring your own share. Remember that in the other technique, we attribute to the NCI, but here you bring your own share. Then current share, you then what? You then have profit, you split between NCI and the parent. You then eliminate the dividends. And if you have OCI, you split between the NCI and the parent. That's what you do. And then, where are we? Then we have acquisitions and we have loss of control. When you lose control, what do? You reverse the gain in separate financials. And you do what? You recognize the gain at a group level. And the difference goes to investment. So that is the difference in the techniques. So you will be what? You will be required to choose which technique you prefer, and you will then be expected to apply it consistently under exam condition. So just be a bit careful on how the two methods think differently. Then losing significant influence, it is what? Losing significant influence is only for level 2. So I've just detailed the step that one just needs to think about when they lose control, when they lose significant influence. So you will determine the gain or loss in the separate financial statements because you disposed of an investment. And the difference will be the original cost and the proceeds received. Then determine the gain or loss in the group financials. Remember, this is in the separate financials. And you will then compare the difference, or you compare the carrying amount of the equity accounted investment and the proceeds received. So do you see step number one? Step number one is the cost of the investment against what? The proceeds. Step number two, it is the carrying amount of the equity accounted balance and what? And the proceeds. So it's like you calculate two gains, but the one is for group and the other one is what? Separate financials. Then when you prepare the pro forma journals, you eliminate number one and you recognize number two. And the difference will be what? The difference will be investments. Then step number 4, you will transfer all the applicable what? Reserves from equity to retained income. Otherwise, you will reclassify items from OCI to P and L. So that is how you deal with what? That is how you deal with loss of significant influence, which is something that you will see when we also look at what? When we also look at the screencast for test number 3 for level 2. But I would want you to challenge yourself and go look at it and follow these steps, and you will see that that was a very what? That was a very nice question. So that was Omega. Sibusiso, have you thought about it? I did not get the loss part well for both. What do you suggest? Where can I see it? What do you suggest? What do you suggest in terms of what? Oh, no, you just choose whatever you want there. Yeah, so there for me, it's a matter of comfort. And Frontier Property is the one where it actually shows us that whatever you choose, you'll be fine. Because they have two answers at the end of the day. What do you mean step 4 and 5 are not part of the calculation? What does that mean? Step 4 and 5 are not part of the calculation. Which calculation? They're not showing this. Which calculations are you talking about? Which, remember, this is not B98, this is associate. This is not B98, it's associate. So you are accounting. I'm not at accounting level yet. Just go back to the very beginning of amortized cost. Just go back to the very beginning. I want you to just think about how did I get here before I talk about the accounting. Okay. Yeah, you guys, I'm gonna tell on you on ASIN. Think business model and what? And contractual cash flows. Yeah, go to that